Oh, hello. Uh, Thanks for being with us. Today, I want to discuss IS 36, Impairment of Assets. So, as usual, I'm CPA Ngenda, and I want to thank you for being with us. If you haven't subscribed, please subscribe and share the video such that we can understand these international accounting standards, but also other accounting and financial aspects. Now, what is impairment? We need to first understand the meaning of impairment before we go into its practical application. Impairment is the foreign value of an asset such that its recoverable amount is less than its carrying amount in the statement of financial position. In other words, it is the amount by which the carrying amount of an asset exceeds its recoverable amount. So now, there are two keywords we need to understand. One being the fair value of an asset. Two, the carrying amount. Then three, the recoverable amount. So those are the three keywords we must understand such that we are able to practically apply the provisions of IS 36. Now, the recoverable amount is the higher of the asset is fair value less cost to sell, what we refer to as the net selling price. So in that case, we get the selling price less cost to sell, but also its value in use. So now we need to compute the fair value less cost to sell or the net selling price. We compare it with the value in use. Later we shall see what is value in use. Then the carrying amount is the net book value that is arrived at by getting the cost less any accumulated depreciation and impairment losses. So that is the carrying amount, or what we refer to as the net book value or the carrying value. Now, the fair value less cost to sell, of course, can be obtained from the sale of an asset. And when we talk of costs to sell, we mean sales transaction costs, such as legal expenses, brokerage fees, advertising, and many others. Now, what about value in use? This is the present value of estimated future cash flows, and of course, if there are any outflows, you less them from inflows that an asset is expected to generate at the end of its expected useful life. So now, from that, now that we have understood the key points, I think now we are able to go into the practical bit. But before we go into that, we need now to understand the indicators of impairment. What shows that an asset has impaired? We have both external indicators, but also internal indicators. We are going to start with the external indicators. One is a foreign value of the market value of an asset. Now, if for example, the value of an asset, the market value of an asset has significantly fallen, it shows that the asset has impaired. For example, if a certain brand of motor vehicle, for example, if you bought it, let's assume at 100 millions, and now, according to the accounts or the records of an accountant, you find that after like 3 years, its net book value is, let's assume, 80 millions. But when you look at motor vehicles of similar brand or similar nature, find that the market, even the new ones, their market value has fallen up to, let's assume, 60 millions. So it means that if you are to sell that motor vehicle, what the best you can recover is about 50 millions. Yet its net book value, according to the books or according to the records of the accountant, is 80 millions. It means the vehicle has impaired. And of course, due to market value of which the entity has no control over. The second indicator is a significant change in technology that significantly, of course, affects the performance of the asset. A good example here is the evolution of computers phasing out the typewriters. So now, with the evolution of computers, I think the typewriters are supposed to be tested for impairment. Why? Because the technology adversely affected the use of typewriters. Then 3 is an increase in the market interest rate that is likely to affect the discount rate used in calculating the value in use. So now, when the discount rate increases, then the recoverable amount reduces. And if it reduces, it means that the carrying amount will be higher than the recoverable amount, hence leading to impairment of the asset. Then another external indicator is the carrying amount of the assets being more than its market capitalization. So now, those are the external indicators of impairment. Now we can look at the internal indicators, one being evidence of obsolescence or reduction in performance of physical damage. So if, for example, there is expiration or there is reduction in performance or physical damage, that is an internal indicator of impairment of the asset. Then 2, adverse changes in the use to which the asset is put or the asset has become idle. This is, for instance, where you find that you have an asset but you no longer get jobs for it, you no longer get assignments by the clients. And therefore, if that is the case, it means that the asset impaired and therefore it should be tested for impairment. Then reduction in performance. A very good example is when you buy a motor vehicle carrying, let's assume, 15 tons. But after some time, you find that it can no longer carry even 5 tons. Now, that is an indicator of reduction in performance, and therefore, it shows that the asset impaired. Now, what are the disclosure requirements in accordance with IS 36, impairment of assets? One, of course, when you talk of disclosures, these are the items that should appear at the face of the financial statements, especially when we are for preparing the annual reports. One is we have now to disclose losses recognized in the period. All the impairment losses must be disclosed. Two, any impairment reversals recognized and their corresponding amounts. If impairment, for example, reversed, that incident must be disclosed also. Then three, the nature of the assets that got impaired should also be disclosed. Then the basis or the preamble used to determine the recoverable amount, but also the discount rates used to determine the value in use. So now those are the disclosure requirements that must be disclosed by the accountant while preparing the financial statements. So now we are going now to look at a practical example where we are going to see how we practically apply IS 16 such that we can arrive at the impairment, but also look at the accounting treatment. If an asset impairs, what happens in the books of accounts? Now, we have an example here and says that Kim Uganda Limited holds a number of non-current assets which are carried at cost less depreciation. These assets costed 3 billion on 1st April 2019 and are depreciated on a straight line basis over their useful life of 5 years. An impairment review carried out on 31st March 2021 concluded that the projected cash flows relating to these assets were as follows. Yeah, as at 1st March 2022, the cash flows were 720 millions. Then in 2023, the cash flows were 675 millions. And as at 31st March 2024, the cash flows are projected to be 577 millions. So now, if you look at this first part of the question, an impairment review was carried out on 31st March, but the assets were obtained on 1st April 2019. So if you can count from 1st April 2019 to 31st March 2021, automatically those are 2 years, because the first year ends on 31st March 2020, and of course the second year ends on 31st March 2021. The company weighted average cost of capital is 10% per annum. However, a market survey by the company marketing department concluded that these non-current assets would fetch a market value of 1.67 billion on 31st March 2021, with associated costs to sell of 24 millions. You are required to advise the company on the accounting treatment of the events stated in the case above. Now, how do you deal with this? We have seen from the theoretical part of the standard that impairment is equal to the carrying amount of the asset minus the recoverable amount. And you have defined each of those terms. Now, how do we get the carrying amount? As usual, if we can borrow knowledge from IS 16, property, plant and equipment, we get depreciation by getting the cost minus scrap divided by the useful life of the asset. So now here in this question, we don't have the scrap. What we have is the cost and the useful life of the asset. So now we are going now to be helped by those two to get the depreciation per annum. And the cost is 3 billion. Then divide by 5 years. What you get 600 millions per annum as depreciation. Therefore, to get the net book value as at the date when impairment review was done, and that is 31st March 2021, what you do, you get the cost minus accumulated depreciation for 2 years. And when you do that, automatically you get 1.8 billion. So that is the carrying amount. Now, this carrying amount must be compared with the recoverable amount to ascertain whether we have impairment or if, for example, we have a reversal. Now, how do you get the recoverable amount? From the definition, we have seen that the recoverable amount is the higher of the asset is fair value less cost to sell and its value in use. So now we have to look for the fair value less cost to sell, or what we term as the net selling price. We compare it with the value in use. But how do we get the value in use? You discount the expected cash flows from the asset using the cost of capital that is provided in the question. So now, fair value or the net selling price, of course, we get from the question we have seen that the marketing department concluded that these non-current assets would fetch a market value of 1.647, but with associated costs to sell of 24 millions. So to get the fair value less cost to sell, you get this market value minus the associated cost to sell. So let's do it. Now we got it here, and the fair value is 1.623 millions. So after getting the fair value, we need to look for the value in use. And we are going to discount the expected cash flows from the assets and the remaining useful life. Now, in the years, we have the column for years here, as you can see. Let me paint it red. The column for years is here. The year 1 is 2022, year 2 is 2023, and year 4 is 2024. So now here we have a column for cash flows. In year 1, we expect to get 720 millions. In year 2, we expect to get 675 millions. And these figures are in the question. In year 3, we expect to get 577 millions. So now, those are the cash flows. We are going to get the discounting factors. How do we get the discounting factors? We use the formula. The formula is 1 plus r to power negative n. 1 plus r to power negative n. So now, where r is the rate, r is the rate, and n is the number of years. So for year one, our year one is 2020 what? 2022. In year one, our n becomes 1. So if you work out this, and we are told in the question that the cost of capital is 10%, the weighted average cost of capital is 10% per annum. I am painting it red. So now, the rate, meaning here the rate is 0.01. 10% is 0.1. So now, for the case of year 1, n becomes 1. Then year 2, n becomes 2. Year 3, n becomes 3. So if you work out, if you put in the formulas, this is what you get. Let me paint it maybe green. This is what you get. This is what you get. Then in year 3 you get 0.751. Now, after you multiply, you get the cash flows here. In year 1, you multiply by the discounting factor here. In year 1, then you get the present value here. You get the present value. I am painting it. Right. Then even in year 2, you do the same. And eventually, you add, you total up this column of the present values to get the value in use as 1645.5. Now, the standard says the recoverable amount is the higher or fair value less cost to sell and its value in use. So now when you see here, you'll find that our fair value less cost to sell was 1623. I'm painting it red. But our value in use is 1645.5. Meaning our value in use is higher. And therefore, it's going to work as our recoverable amount. So after getting the recoverable amount, we compare it now with the carrying amount. Because impairment is equal to the carrying amount minus recoverable amount. You remember from our workings, our carrying amount was 1,800, 1.8 millions. 1.8 millions. Compare it with our recoverable amount of 1.645.5 millions. What you get is 154.5 millions. Now, after getting the impairment, of course, as an accountant, you have to report. Now, this impairment reduces the assets account. Credit the assets account and debit the profit and loss. The impairment loss. So that is how we treat impairment of assets. Now, In the financial statement, especially the balance sheet, this asset will appear at its recoverable amount of 1645.55 millions. Not its carrying amount. Why? Because it impaired. That's why we have to recognize this impairment loss as an expense in the statement of profit or loss account. So that is how we treat impairment of assets or IS 36. So for today we can end here. I want to thank you for listening, but also viewing our videos. I want to implore you to really subscribe, share, and comment such that we can make the service or we can bring it better. Thank you very much. May God bless you.